Dan Loeb is one of America's most successful hedge fund managers with an average annual return of around 16% from 1996 to 2015. First, we'll look at his fascinating background story before discovering his powerful strategy that turned $3 million into over $18 billion. Born in Santa Monica, California in 1961, Dan Loeb was raised by well-educated parents. But despite his parents wanting him to take on a more traditional path as they did, young Dan was different. Incredibly, at only 6, Dan Loeb was already fascinated by investing. Whereas most 6-year-olds are busy playing with Hot Wheels and Barbie, Loeb was already far ahead. He says he was introduced to understanding the value of money from a very young age because entrepreneurship runs through his family. At 6, while his classmates played with those Hot Wheels and Barbies, Loeb tried to understand the business behind them. Interestingly, it just so happens that his great-aunt was the creator of Barbie. In fact, his great-aunt and uncle founded Mattel, a toy manufacturer that produces well-known brands such as Hot Wheels, Fisher-Price, Uno, and Barbie. With such a powerful family background, it's fair to say Loeb had a great opportunity to learn about business. However, despite the great opportunity, young Dan often got in trouble at his high school in Los Angeles. Shockingly, one day he was threatened by bullies who said they would beat him up extremely badly. But the bullies didn't realize who they were messing with. Dan was already wise with his money even at a young age, as he hired his tough classmate Robert as a bodyguard. He paid Robert 25 cents per day and nobody ever started a fight with him again. To this day, Loeb uses his aggressive language to criticize those who don't perform well through public letters filed through the U.S. Securities and Exchange Commission. His passion for math and finance grew at Columbia University, where he made $120,000 in profits from investing in the markets from his dorm. Incredibly, Loeb wasn't to know that he was sharing the class at Columbia University with a man who would go on to become one of the greatest U.S. presidents, Barack Obama. But life wasn't all easy for Loeb. Suddenly, he faced his first major shock after losing all his $120,000 in profits, leading him to have major doubts about his investing abilities. He lost it all after his very heavily concentrated investment in Puritan Bennett, so Dan realized he must diversify his investments. Remember, $120,000 is worth around 4 times more today than in the 1980s. Also, he used leverage to buy the shares, which meant he couldn't cover his losses for a long time. Loeb says it was a 10-year lesson in the perils of leverage and over-concentration positions. He realized he could not continue like this, so he decided to become an analyst at a private equity firm called Warburg Pincus to develop the necessary skills to analyze companies. Soon after, he was making over $100,000 a year and learned so much from the new role. While at the company, Loeb had a gift for picking great stocks such as CNW Corp., which made Warburg Pincus over $20 million. But just as things were going so well, suddenly he made a career move that would be shocking to his friends and family. Loeb decided to take a job in the music industry. Yes, you heard that right. He changed his career in private equity to work for a record label where he would be the director of corporate development. After around a decade in New York, he became more engaged with the music scene and soon started to hang out with popular hip-hop artists. However, Loeb soon had enough of the music industry, and he moved back into finance, taking on jobs at hedge funds. He worked for Laffer Equity Investors, and after he took a role at Jefferies in 1991 to work as a sell-side analyst where he learned so much. This wasn't enough though, so he quickly moved on to a role at Citicorp, where he became a high-yield sales vice president. Soon after, Loeb began to form powerful relationships with Wall Street hedge fund managers such as David Tepper, who runs Appaloosa Management. But Loeb still wasn't satisfied. He wanted more. Way more. So he decided the only way was to make a very bold move to quit his job and start his own fund called Third Point Capital in 1995. Loeb planned to raise $10 million. However, the fund began with $3.3 million, which he raised from some of his most wealthy friends and family. Also, it took him years to hire his first full-time employee in 1997. Soon after, he had a major problem, though. He said he regularly questioned what he was doing and felt like a fraud. Loeb became overwhelmed with how much he had to learn about leadership, management, and developing company culture. It didn't come easy for Loeb, as he didn't go to business school and didn't pick things up quickly. However, Loeb had something his competitors didn't have. It was a relentless attitude toward continuously improving and learning by attending classes and reading books. For example, he went to a leadership class at Goldman Sachs, where he met a coach with whom he had been working with for several years. They frequently spoke and read books about leadership, which helped Loeb overcome his problems of feeling like he wasn't good enough. Incredibly, in only his first month, he made 80%. Still, he knew he must not get too overconfident, as he had lost a large amount of money the last time he was up so much, so quickly. His solution was simple, yet incredibly powerful. He became known as an activist investor who would gain large stakes in companies to get seats on the board. Loeb's goal was to have a majority controlling stake, or at least have some voting rights. He did this so he could have enough power to make major changes to a company's operations and management. Essentially, he would target underperforming companies and publicly expose their flaws. The strategy was ruthless and aggressive. As a result, Loeb would often push the CEO and other board members to resign, which allowed him to get better management in place. The amusing part is that he usually signed the letters, "Very truly yours, Daniel Loeb." Here are two major examples. In 2011, Loeb thought Yahoo's declining stock performance was mainly due to poor management, leading him to criticize the board publicly. Following the criticism, the company had an overhaul from its board, which resulted in Yahoo's stock price rising rapidly. The second example is Sony, which had significant operational restrictions when he bought a large stake in the company. After investing in Sony, Loeb helped transform the company into a more efficient one, which helped the stock price rise. Loeb frequently criticizes CEOs. For example, after buying PotlatchCorp, the stock crashed, so he called CEO Pendleton Siegel a CVD, meaning Chief Value Destroyer. The open letter criticizing the CEO came after the company announced a phased voting rule, which means shareholders needed at least 4 years of stock ownership before being able to have full voting rights. Loeb had a fair point. Since the CEO had joined, he claimed that the shares dropped over 45%, resulting in over $520 million of shareholder value being lost. And Loeb was right. Just after he started his criticism in March 2003, stock was $18. However, by August, it closed at $56, up over 200%. Following the encounter with Loeb, Potlatch's Siegel said that he's dealt with all kinds of people, but Loeb is pretty much at the extreme. Loeb is proud of his letters, and hedge fund guys enjoy reading them. He goes in hard and publicly shames CEOs regarding their incompetence and poor results. Apparently, he even increased his share in a company from 4 to over 5% so that he could publicly criticize a company's board. Apparently, according to a lawsuit in 1999, Loeb used a web handle called Mr. Pink, inspired by Quentin Tarantino's classic film Reservoir Dogs.
Why am I Mr. Pink? Because you're a
Mr. Pink first appeared on SilicoinInvestor.com early in Loeb's hedge fund career. The website was taken over by InvestorsHub.com, and it allows users to post anonymous messages about public companies. Mr. Pink would post about stocks he thought would perform well and shorting companies with poor management. However, Loeb mentioned that he can't confirm or deny any relationship with a web user called Mr. Pink, while he does agree with some of his views. Another strategy Third Point used was to take part in distressed debt investing. A distressed debt investor is basically somebody who buys bonds in a company that is near to filing for bankruptcy. When a company is in a very poor state, it sells bonds at huge discounts to help attract investors. This approach came with great risk and reward. However, Loeb researched the company deeply to see if his fund could profit. If a company emerges from bankruptcy, it can often cut its debt and deliver very high returns. For example, Loeb bought Warnaco at bankruptcy at only $6.50, which he later sold for $16.50 per share. Third Point would often take advantage of buying undervalued stocks to profit from the compounding value growth over time. But as his fund grew, each decision had more significant consequences, and the pressure was building. By the year 2000, Third Point had grown its assets under management to $136 million, only 5 years after being founded. Loeb would have his first breakthrough, leading to the dot-com internet bubble in the year 2000. He saw something many did not. Tech stocks were rallying, however the bubble burst toward the end of the year 2000, and Loeb profited significantly. Soon after, Loeb and his team soon caught the attention of major players in the financial world and helped his fund grow to around $5 billion in assets under management. But just as things started to look promising, Third Point would be hit with its first massive challenge. It's 2008, and the financial crisis causes his fund to lose over 30%. Soon after, his assets under management plummeted to $2 billion. After 13 years of hard work building the company, Loeb felt everything he worked so hard for was drifting away. However, he remained upbeat despite the challenging period. He says that mistakes are part of the process. What matters is how you recover. and soon enough he bounced back with the fund returning around 38% in 2009 and 41% in 2010. To put that into perspective, the S&P 500, including dividends, only hit 15.1% in 2010. However, in recent years, the fund has not made such large gains above the S&P 500 as opportunities to profit from shorting the stock market have reduced over the last decade. Also, as Third Point gains public exposure, he must consider factors such as sustainability and ESG. As a result, Loeb is keen to shift more money into renewable energy, which has great long-term potential. His strategies are high risk and high reward. However, Loeb found a way to be successful consistently, and in recent years he has reduced the risks of his approach by adapting better to the market. Many believe his approach is an extreme example of shareholder activism that heavily impacted corporate America through the 1980s. It's not unfamiliar to see powerful hedge fund managers help push out CEOs from some of America's leading companies. However, Loeb's style is slightly different as he makes his criticism loud and public to disrupt a poorly performing board. You may think this is a negative thing. However, we need people like Dan Loeb to help create a healthy corporate environment that's driven to improve. Without people like him, we would rely more heavily on activist investors to build shareholder proxies to change corporate votes. This type of behavior contributes significantly to his fund consistently beating the market. Critics argue that his approach gives less predictable returns for investors. However, it also sets his fund apart from the competition. Also, some activist investors disagree with Dan Loeb's public and upfront approach. While it can be effective to go public, it can also be time-consuming and costly, according to Eric Miller, who manages a fund with over $2 billion. Miller suggests that it should be the final option if nothing else works. However, whatever critics say, Loeb's record speaks for itself with just one bad year in 2007. His approach is not to take over companies and change control, but rather to get boards to do better. Dan Loeb's ability to spot opportunities and drive change has made him one of America's most successful hedge fund managers. Third Point has consistently delivered double-digit returns, and his no-nonsense letters to CEOs have highlighted his success. In 2024, Loeb predicted a Republican Party win before the result was announced. He stood well-positioned to profit from lower corporation taxes and regulations that the Trump administration promises. Additionally, Loeb is looking forward to less merger and acquisition regulation and the potential removal of the Biden administration's activist antitrust stance. With Third Point managing over $7 billion in 2024 and returning double-digit returns frequently, it's fair to say his approach has been very successful. As for Mr. Pink, rumor has it he's still complaining about his name.
Mr. Pink, let's move on.
I make videos explaining fascinating financial stories, so make sure you subscribe and check out more stories here. Thanks.